Hi everyone, welcome to Financial Insights. I'm Linda, your accounting coach. Today I want to talk about chart of accounts. It never fails. When I meet with someone to review their financial statements, the question they always ask, am I using the right accounts? Am I doing the right thing? And I always tell them there's no law or statute, no one's coming to get you because you're using a wrong account. The chart of accounts is your decision. In accounting, there's many different pieces, and one of the pieces is chart of accounts. It's the foundation of your accounting records. So today I want to discuss what is the chart of accounts, why it's important, and what is in the chart of accounts. So let's get started. So what is the chart of accounts? The chart of accounts is just a list of accounts that you use to classify your transactions. I call them buckets. So if you think about when you create your personal budget and you have rent, you may have mortgage, you have utilities, you may break that out into water, gas, electric, transportation, you may have education expenses. This is similar to your business chart of accounts. These are just accounts, or QuickBooks called them categories that you put your transactions into. So instead of looking at 100 transactions on one report, your accounting system takes all those transactions and roll it up into one account. As I stated before, there's no law on how you set up your chart of accounts. I would suggest you be consistent. So this is where you have to know your business. So if you are a product-based business, you should have a cost of sold account. So once again, if you produce a product, there's certain accounts you will need. If you have created a budget and you have included hardware, software, printing, marketing, social media, rent, you want to use those same categories in your chart of accounts. So once again, a chart of accounts is just a list of accounts. I call them buckets. So basically, you're just putting the transaction into a bucket. So let me show you in a PowerPoint presentation that I gave last year how the chart of accounts works. I am going to share my screen, and I created a workflow to explain how the transactions work. So if we look at this presentation, all of your transactions, you have your bank account transactions, you have your cash transactions, if you have created journal entries, if you have created invoices, bills, or checks in your accounting system, all of those transactions roll into your chart of accounts. So you're telling your accounting software to put all of those transactions into an account. Your chart of accounts then flows into a financial statement, so into some type of report. So you use the financial statements for tax purposes, loans, and grants. So that's why the chart of accounts is so important. The chart of accounts, once again, helps you classify. Number two, it is used for reporting. It's solely used for reporting. You need a chart of accounts so you can actually produce a profit and loss statement, balance sheet, cash flow, and other accounting statements. So what is in the chart of accounts? So you have all of these different accounts, and these accounts are classified into types. So the balance sheet includes assets, liabilities, and equity. I am going to highlight so you can see. So once again, the balance sheet includes your asset accounts, your liability accounts, and your equity account. Your profit and loss statement includes your revenue accounts and your expense accounts. I suggest when you're creating your chart of accounts, or if you already have one, you want to have multiple revenue accounts if you produce more than one product or provide more than one service. Why? Because this will tell you where your revenue is coming from. If you lump everything together in the revenue account, you won't know if it's product A, product B, or product C. So once again, have multiple revenue accounts. If you have the QuickBooks version or another accounting software where you can create classes, use the class so you don't have to have multiple revenue accounts. I'll make a video more about classes and how to group accounts later on. But once again, for profit and loss statement, you have revenue and expenses. The balance sheet, you have assets and liabilities. This is very important to know your business, because if you are coding transactions to the wrong account, your financial statements will be incorrect. So that's why it's so important to have a good chart of accounts. I suggest you review your chart of accounts probably like every 2 years. So accounts that you're not using, make them inactive. You may want to change the name, or you want to maybe create new accounts so you can really understand what's going on with your business. So don't just assume that your bookkeeper or your accountant is looking at chart of accounts. This is probably one of the biggest common mistakes or common things organizations do not do. They don't go back and look at their chart of accounts. I've seen chart of accounts that have accounts that they have over 1,000, 2,000 accounts because no one ever went back and deactivated or changed things. So you don't want your accounts to be so cumbersome. So number one, do an audit every 2 years. Number two, make sure you break out your revenue. And number three, do an audit yourself. Don't assume that your accountant or bookkeeper will do it for you. So thanks for watching. Make sure you subscribe to our YouTube channel to view more mini lessons.